Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our econ show. We're going to break it into 5 segments. Hopefully it'll be a little bit faster because we don't have as many slides as normal. We have 77 versus what is normal, which is typically has been over 100. So hopefully we'll go a bit faster. But we want to look at in segment 1, global trade. We've talked about how it's been slowing. The data came out for December. It did slow again. And then we want to look at some of the PMIs that have happened and then talk about, we discussed it last year more aggressively in terms of the good and bad within PMIs and why it's good to look at, but look at other pieces as well, because you can also get some false starts and some false positives in both good and bad directions. And that's something that we always want to look at. So we also want to talk about the food shortage side because some of the data has come out for Argentina, Brazil, India doesn't look good. We want to go through what does that mean. And then we want to look at economic recoveries in the US and how the real estate and manufacturing side continue to show that there's problems within that, just because the real estate front continues to be concerning. We had a bankruptcy from PIMCO, or I should say defaulting on bonds from PIMCO, Brookfield, and then now another from Blackstone in Europe. So these are things that we want to review. Then we want to look at some of the regional Fed data and how it's flashing again, some more of those warning signals. Then we're going to look at European inflation, which I know you'll be shocked to know it accelerated again for those that have been following us. It shouldn't be a surprise. And then we're going to look at Chinese data and how it's rebounded, and then go through the details of it and pick out the good and the bad. And again, like as we try to say, we're not here to say, oh, well, we're bearish China, therefore everything is negative and we can paint the bearish picture. It's like, no, it's the data bounced. This is where it was good. This is where it was bad. And this is where it's trending. And that's really why we do this and why we want to talk about it, is to show you multiple data sets, multiple opportunities within it, and then give you our opinion on where that trend is going to be. We still think that trend is down. But again, you have to look at why that's the case, given the fact that the numbers on the top line were positive, and that's going to be an important piece. So getting right into it here, you can see that the world trade volume dipped down, but clearly the dip, as you can see going back to 2000, it's small. We're dipping from all-time highs. So it's relative in factor, but the global trade volume contracted in December for the third consecutive week, taking the 3-month change to negative 3.7%, which in theory is the worst since the pandemic, and before that, the worst since the global financial crisis. Neither of which we think is going to happen here for global trade, but it's just putting it into perspective and something that we've been saying from the beginning, because if you look at the trend has been, even gradually speaking, higher. Our whole view is that globalization has really kind of peaked to this point, and now you're going to start to see this come down. We are not saying that World Trade Volume Index is going to go from 131.8 to 90. That is not what we are saying. We are saying that global trade volumes are going to go from 131.8 to 127. And it'll likely just bounce around in this level, and that is going to be enough for a broader problem, given the leverage in the system, given the dollars that need to be moved to the emerging markets, and given how important these volumes are for places like China, places like Asia, and how that's going to continue to eat into some of the economic data sets, which is why we remain concerned for 2023 on a global growth level. And this is going to be one of those things that we're going to continue to watch. Now, one of the reasons why we think that trade comes down is because you can see here that pretty steady move down in global manufacturing PMI, and you can see it's flatlined and it's bounced back up to 50. 50 is neither contraction nor expansion. It's just kind of the same. And it's important. So PMI is a diffusion index, and it's based on getting different inputs, valuing different things based on where they're coming in at. And there's inventories exploding higher can be viewed as good. Supply lines, supply chains can be seen as good or bad, even though they're just normalizing. And it's important to look at these different pieces. And it's also, you're asking people's opinion and how they feel at this point. And things looked really bad. Now you're starting to see a little bit of that stabilization. So on a month-to-month period, you could say, well, things are less bad. They're not great, but that gives people a little bit of confidence. Our view, and this is because the numbers are looking backwards, our view is that as the market now comes to terms or comes to the understanding that Powell isn't going to cut rates, Powell's actually going to continue to increase rates, and it's going to remain there for, let's call it 12 months at this point, that's going to be another downside pressure point. It's important to say, and we've tried to highlight this, we don't think that global manufacturing is going to nosedive to 43. It's going to bounce around between that 48 and 50 level. Maybe on a bad month you go to 47, but realistically you're just going to sit here in a slight contraction, and you're seeing that play out in middle distillate, diesel, local manufacturing, local export expectations, local looking at specific countries. And that's where we see that underlying concern, and that's something that I think is going to continue to play out over time. It's just a matter of who follows that trend and where does that trend go. S&P Global ASEAN Manufacturing PMI had a nice bounce. Even though some of that has gotten better, Japan has worsened, South Korea has gotten worse. I should say has stayed the same month over month. Taiwan has gotten a bit worse. So there's just a mixture of, there's some good things, there's some bad things. And you have to consider ASEAN nations feed into, whether it's either finished products or semi-finished products into China. China reopened. There's going to be a natural progression of stuff into China, which is what we had highlighted, is that China's going to reopen. You're going to get a nice move up. But then there's going to be a fade. And it's something that if you look at the data going back to 2020, you can see when China reopened and then when things kind of normalize. And that's the back and forth that we keep talking about, where you get a makeup number and then you start to just normalize. And now China will likely stay in expansion. We said that before these PMI data numbers came out. They're even higher than we expected, but we didn't appreciate some of the extremes when you looked at inventory and supply chain. But again, those are benefits that we're going to continue to see going forward. So now when we pick up from the ASEAN side, you can see that the U.S. manufacturing index versus Chinese PMI. So there's going to be some uplift. The question is always going to be how much uplift do we get? And because of some of the intricacies in the numbers for China, you normally don't have the same type of spike, but it does have a move up. So like official Chinese manufacturing PMI advanced 3 months. You can look in 2020 when you had that huge Chinese spike back up. You saw the U.S. respond, but at a more gradual pace because of the different nuances within it. Now, because China was shut down and no one else wasn't at this time, and it was a zero COVID component, there was a lot of disruption across internal supply chains, less on the external supply chains. So you're still going to get a benefit, but it's not going to be to the same degree. And then when you look at that Asia export activity versus ISM, this is where we see some of those bigger concerns when you look at Asia export activity, where the export activity is coming down. But it's important to look at it's slowing, but going back to the first slide, slowing is relative. Even though it's slowing and you could say, oh, it's a 3-month trend, it's like, okay, but let's put it into perspective. We're not going where the world is shutting down and we're going to have all of these ships that are going to be unused. It's just you're going to see a general slowdown that is going to be fairly stable in movement. And here's just, again, more of those leading indicators showing some of that underlying softness. Now, some of the key things when you look at the probability of a heat wave for March in India, this is going to be a bigger concern because it calls into question, again, manufacturing components because of electricity prices. Are there going to be brownouts? We've already talked about, Section 11 being enacted in the power bill to ensure that there's enough power. But this also creates a problem for food because some of the key pieces on the food front are real. So after its hottest February on record, which is going back to 1901, India may see more heat waves between March and May, possibly bringing down crop yields for a second straight year. Important to say, second straight year. because one of the things that we've been talking about extensively is that all of the problems on food don't happen overnight. It's a cascading event, and this is going to be the second straight year of problems. March is the most critical month for winter-sown crops like wheat. India will face hotter weather over the coming months, stoking concerns about a repeat of the intense heat wave of last year. Again, last year, this year, seeing some of the trends that risk damaging crops and further straining the country's power network. The Weather Office expects an enhanced probability of heat waves in most of the country during the 3 months ending May 31st. Electricity demand to be near record levels and led to the Farm Ministry setting up a panel to monitor the impacts on the wheat crop, which is expected to reach a record this year. Key thing. Last year, India suffered its hottest March in more than a century, scorching the grain harvest and forcing the government to curb exports. Now, that's one component of it. Now, if you think about where India gets its fertilizer, some of its trade piece, some of this, if not a lot of it, comes from Russia. On Wednesday, top Chinese diplomat Wang Yi met with Russian President Putin in Moscow on the eve of the first anniversary of Russia's invasion of the Ukraine. On Tuesday, Putin gave a speech blasting the West and defending the necessity of his special military operation. Wang had warm words, saying China-Russia relations enjoyed a solid political, economic, and cultural foundation. We would argue on the cultural, but that's neither here nor there. This is because a multipolar world and greater democracy and international relations, which China and Russia jointly support, are in line with the trend of the times and the aspirations of most countries. He also said China was willing to work with Russia to deepen political trust, strengthen strategic coordination, and expand practical cooperation. India and China do not like each other. China and Russia historically have gone back and forth, but are typically will warily look at each other and work together as an enemy of my enemy is my friend. But Russia and India typically have very good relations. What is this going to do for a Russia-Indian relationship? Is this going to push India further to the West, which I think the West would welcome? Were they naturally going that way? And these are some of the key pieces that we have to watch from a geopolitical perspective, because that could be interesting, and it could be a fairly deeper shift when you look at relations between India and China getting worse, not better, which is our base case. Now, food makes things more complicated. With the second, corn is only at 26% planted in Parana in Brazil South, well below the 52% average. Only 2021's pace was worse by the same date at 22%. Harvest of soybeans is only 17% complete, same as in 2021, versus a 37% average. So again, this is why we look at some of the issues in Latin America. Cycling that through again, crop conditions worsened in Argentina again this past week. Soybeans are now 67% poor versus 60% in the prior week and 23% last year. Corn is 56% poor versus 51% the prior week and 24% last year. Only 2% of beans and 6% of corn are in good shape. Hot and dry weather is still in the forecast. So they're already projecting to have exports at 2009 levels, and now this crop is already showing a significant problem in general, which when we look at the underlying shifts, this is going to become a bigger thing to watch in general. Now, again, cycling and kind of circling up these different pieces, before Fukushima, 54 nuclear reactors fulfilled about 30% of Japan's electricity needs, and the government had aimed to raise it to 50%. Now, only 10 of the 33 operable reactors are back online, producing less than 10% of the country's power. What does that do to the LNG market? What does that do to the coal market? Because when you look at Japan has to import all of their product, so they're going to have to import more LNG, which is something that they've relied more on from Australia. And now with the sanctions with Russia, what is that going to do to Russian flows going into some of these regions? Are you going to see Russia selling more into China? Speaking of those relationships, maybe more into India. while Qatar, which normally sold more into those areas, now sell more into others. And again, we're just getting a much bigger rejiggering of the supply chain. And the question is going to be, what does that do to European product? What does that do to European inflation, which we've already seen reaccelerate, which we want to talk about in segment 4. And now, globally speaking, I think it's important to look at, and this is interesting. So South Korea set a new record for a new record low for fertility. South Korea lags well behind all OECD member nations on fertility, expected lifetime births per woman, which you could see is now below 1. This is a large problem globally speaking. But obviously on the Asian front, when you look at Japan, Korea, it is a much bigger issue. And and as we've talked about, is an issue within China. The death cross, more people die than are born in South Korea now, which is again going to move things down considerably. South Koreans' willingness to have a baby continues to get weaker. Nation and then Seoul alone, when you look from 1993 onwards, you can see that it's gone from having one child to having no children, because you can't have 0.5 of a baby. So it just means that if you were to ask 2 women what they would want to do, one would say 1 child, one would say none, hence where we get to this average out. And it's a persistent problem, which is going to create a much bigger issue when we look at, economic throughput. It will help, if you will, on the food front, just because of population shifts, but at the same time, it creates an economic headwind. Fertility rates coming down, in particular in the U.S. When you look at the UK, U.S., we've dipped down below what is deemed replacement value when you look at some of the different pieces. But it's important to understand that the top desired destination for potential migrants is still the U.S. So when you look at U.S., Canada, Germany, Spain, so when you look at the replacement side, so you have to look at what is happening locally, internally within a country, and then, well, who are we bringing in? What migrants are coming in? And if you just consider, if you're a parent of 2, if you have a husband or wife, and then you have 2 children, you net to 0, because when you die, your kids still exist, and that keeps things flat. So that's why when you look at the movement, you need to be 2.1 to 2.3 on average to have that steady growth. If you don't have it, which we don't, you have to rely on migrants, and still the U.S. remains the main set, which again is the big issue in general. And that's what we have for you on this side. In the next segment, we're going to go deeper into the U.S. and some of those key pieces that we're looking at from the level of real estate, inflation, and then how that is all merging together to create more economic headwinds when we look at the U.S.